Quote of the day.
The individual investor should act consistently as an investor and not as a speculator. Hello, fellow financial enthusiasts. Today, we're diving into the treasure trove of financial wisdom with a book that's not just a guide, but a beacon for intelligent investing. I'm thrilled to present to you an analysis of the timeless masterpiece, The Intelligent Investor, by the legendary Benjamin Graham. The author Benjamin Graham, often hailed as the father of value investing, wasn't just a financial guru. He was a guiding star for the likes of Warren Buffett, a man whose investment strategies have stood the test of time. Published in 1949, The Intelligent Investor isn't just a book, it's a journey into the heart of value investing, a philosophy that seeks to uncover hidden gems in the stock market and capitalize on them. But what makes this book stand out? Well, my friends, that's exactly what we're here to explore. Whether you're a seasoned investor or just starting out on your financial trip, this book holds pearls of wisdom that are as relevant today as they were over 7 decades ago. So, fasten your seatbelts, grab your notepads, and get ready to embark on an enlightening journey through the pages of The Intelligent Investor. From the concept of margin of safety that shields us from market storms to the intriguing Mr. Market analogy that challenges our understanding of market psychology, we'll unravel it all. We'll learn how to distinguish between investing and speculation, and how to keep our emotions in check while navigating the unpredictable waters of finance. But wait, there's more. We'll delve into the minds of defensive and enterprising investors, unravel the mysteries of market fluctuations, and uncover the psychological traps that even the savviest investors fall into. Plus, we'll explore the book's enduring stance on active versus passive investing, and the game-changing wisdom on the power of a long-term perspective. So, whether you're aiming to make your first investment or looking to refine your financial strategy, this analysis will equip you with insights that have shaped generations of successful investors. Get ready to unleash the intelligent investor within you. Together, we'll uncover the gems that have transformed the way we think about money, stocks, and most importantly our financial future. Stay tuned, because the journey through the intelligent investor begins now. Now that we're all geared up, let's dive straight into the captivating world of The Intelligent Investor by Benjamin Graham. But before we delve into its profound insights, let's set the stage by exploring the book's structure and the genius behind its words. Published in 1949, The Intelligent Investor stands as a timeless masterpiece in the realm of finance. Written by none other than Benjamin Graham, a man whose legacy in the world of investing is monumental. Now, who was this brilliant mind that still echoes through the corridors of Wall Street today? Well, my friends, Benjamin Graham was not just an author but a true pioneer. With credentials that span from being a professor at Columbia Business School to being a mentor to the legendary Warren Buffett, his expertise was nothing short of transformative. Picture this, a young Warren Buffett eager to learn, sitting in the classroom of Benjamin Graham. It was here that the seeds of value investing were sown, paving the way for Buffett's eventual rise as one of the most successful investors in history. Graham's principles didn't just shape a single career, they laid the foundation for a whole new approach to investing. And that approach, my friends, is what The Intelligent Investor encapsulates. Now that we've met the mind behind the masterpiece, let's talk about what's waiting for us within the pages of this treasure trove. The book is a roadmap guiding us through the principles, concepts, and practical wisdom that define intelligent investing. From understanding the fundamental ideas behind value investing to unraveling the intriguing Mr. Market analogy, this book takes us on a journey that's both enlightening and empowering. We'll explore the concept of margin of safety, which isn't just a financial term, it's a mantra for risk management. We'll uncover how to differentiate between investing and speculation, as well as the psychology that governs our financial decisions. Stay tuned, because in the upcoming segments, we'll dive deep into the heart of value investing, margin of safety, and much more. Key takeaway 1: Value investing. We're diving into the very heart of investing wisdom, value investing. In this segment, we'll explore the foundational principle of The Intelligent Investor by Benjamin Graham. Value investing isn't just about picking stocks, it's about picking stocks with a purpose. It's all about the art of finding gems hiding in the financial markets, stocks that are undervalued, trading below their intrinsic worth. So, what's the magic behind this strategy? Well, the genius of value investing lies in the concept of buying low and selling high. It's about looking beyond the market noise, delving into a company's financials, and assessing its true value. Graham's book urges us to conduct thorough fundamental analysis to understand a company's earnings, assets, liabilities, and growth prospects. By doing so, we can identify stocks that have temporarily fallen out of favor with the market, presenting us with an opportunity to buy at a bargain. You see, dear viewers, value investing is like hunting for treasure in a sea of numbers and market fluctuations. It's a patient game, a strategy that requires discipline and a long-term perspective. And here's the magic term: margin of safety. This is where Graham's brilliance truly shines. It's the extra room you leave between the stock's market price and its intrinsic value. It's your cushion against uncertainty and market volatility. By embracing the margin of safety principle, you're not just investing, you're protecting yourself from the unpredictable swings of the market. You're setting yourself up for success even when the market takes a nosedive. So, whether you're a seasoned investor or a curious beginner, value investing, as championed by Benjamin Graham, empowers you to be an intelligent strategic investor. It's an invitation to look beyond the surface to understand the true worth of a company and to capitalize on its potential. As we wrap up this segment, remember that value investing is a mindset, a philosophy that teaches us to be patient, analytical, and always on the lookout for hidden opportunities. Join me in the next segment as we explore another gem from The Intelligent Investor. Key takeaway 2: Margin of safety. In this segment, we're venturing into a concept that's like a shield against market storms: the margin of safety. It's a concept that not only defines intelligent investing but also embodies the essence of Benjamin Graham's wisdom. Imagine for a moment walking along a narrow path high above the ground. You wear a safety harness, not because you expect to fall, but because you're prepared for the unexpected. That's precisely what the margin of safety is in the world of investing. This brilliant concept is like a financial cushion or a buffer between the price you pay for a stock and its true value. It's the gap that protects you from potential losses caused by market volatility, economic downturns, or even unexpected company issues. Graham's wisdom teaches us that successful investing isn't just about buying stocks, it's about buying them at a discount. By purchasing stocks below their intrinsic value, you ensure that even if the market drops or the company faces challenges, you have a safety net in place. Think of the margin of safety as your partner in risk management. It's what sets intelligent investors apart from the rest. While others might be swept away by market euphoria, you're anchored by a rational approach that minimizes the chances of loss. And the best part? The concept isn't limited to stocks alone. It can be applied to various investment vehicles from bonds to real estate. It's a universal principle that empowers you to make informed, calculated decisions. So, as we wrap up this segment, remember that the margin of safety isn't a mere concept, it's your shield against the unpredictable tides of the market. It's your foundation for intelligent investing, one that Benjamin Graham imparts with timeless wisdom. Key takeaway 3: Mr. Market Analogy. Get ready to explore a captivating analogy that's like a window into the mind of the market, the Mr. Market Analogy. In this segment, we're delving into another brilliant insight from The Intelligent Investor. Imagine you have a business partner named Mr. Market, a quirky character who shows up at your doorstep every day, ready to buy or sell his share in your business. Now, here's the twist: Mr. Market's emotions are as volatile as the wind. One day, he's ecstatic, willing to buy your share at a premium price. The next day he's gloomy, offering to sell at a steep discount. Mr. Market's moods swing wildly, but here's the kicker: you're not obligated to follow his lead. Benjamin Graham brilliantly uses the Mr. Market analogy to illustrate the market's irrational behavior. He wants us to recognize that, like Mr. Market, the market itself can be moody, driven by emotions, news, and fads. The key takeaway here is that as intelligent investors, we don't have to let Mr. Market's emotions dictate our actions. Instead of being swayed by his highs and lows, we can approach the market rationally and calmly. So as we conclude this segment, remember that Mr. Market isn't your boss, he's your business partner. Approach him with a clear head, a rational mindset, and a focus on long-term value. Key takeaway 4: Defensive versus enterprising investors. In this part, we're diving into a fascinating aspect of investing psychology: the distinction between defensive and enterprising investors. Get ready to unlock another layer of wisdom from the intelligent investor. Imagine you're embarking on a journey into the world of investing. As you set foot on this path, you come across two distinct trails, one marked defensive and the other enterprising. Each path offers its own set of challenges and rewards. These two categories aren't just labels, they represent different approaches to investing. Benjamin Graham encourages us to identify which path suits our risk tolerance, financial goals, and level of involvement. Defensive investors, much like their name suggests, tread cautiously. They prioritize safety and stability. They prefer a passive approach, often investing in well-diversified portfolios and minimizing the risks associated with market fluctuations. On the other hand, we have enterprising investors, those who are willing to take calculated risks for potentially higher rewards. They are more active, seeking out undervalued opportunities and conducting thorough analyses to uncover hidden gems. The beauty of Graham's perspective is that he doesn't champion one approach over the other. He acknowledges that each path can lead to success, but he emphasizes the importance of self-awareness. By understanding whether you resonate more with the defensive or the enterprising mindset, you can align your investment strategy with your personality, goals, and the time you're willing to commit. So, as we wrap up this segment, remember that whether you choose the well-trodden path of defensive investing or the more adventurous road of enterprising investing, the intelligent investor equips you with insights to thrive on either journey. Key takeaway 5: Investment versus speculation. In this segment, we're going to untangle a fundamental concept that's often misunderstood: the difference between investment and speculation. Join me as we navigate through the insights of the intelligent investor. Picture this: you have two individuals in a room. One is carefully analyzing financial statements, considering long-term prospects and making informed decisions. The other is chasing after market trends, driven by short-term gains and hunches. One is investing and the other is speculating. Benjamin Graham, with his unmatched clarity, makes a crucial distinction between the two. Investment involves a calculated assessment of value, buying an asset for less than its true worth, with an eye on its long-term potential. Speculation, on the other hand, is akin to gambling. It's making bets on market movements without necessarily understanding the underlying value of the asset. It's driven by emotions, rumors, and short-term trends. Graham's wisdom shines through when he encourages us to be investors rather than speculators. He empowers us to engage in a rational, disciplined approach to finance, one that's grounded in fundamentals, not driven by speculation. The key takeaway here is that investing is a journey, not a sprint. It's about the long game, the careful assessment of value, and the patience to weather market storms. Speculation, on the other hand, is often a roller coaster ride of emotions and uncertainty. Key takeaway 6: Market fluctuations. Get ready to navigate the turbulent seas of the market with insights from the intelligent investor. In this segment, we're diving into the fascinating realm of market fluctuations. Imagine you're on a ship, sailing through unpredictable waters. Some days the sea is calm and inviting, while on others, it's stormy and tumultuous. Just like the sea, the market has its fair share of ups and downs, highs and lows. Benjamin Graham, the maestro of value investing, teaches us that while market fluctuations can be unsettling, they're also opportunities in disguise. He invites us to embrace a different perspective, to see market drops not as obstacles, but as entry points. Graham's wisdom is a reminder that the market isn't a casino, it's a marketplace of businesses. And just as businesses face challenges and opportunities, so does the market. It's a reflection of human behavior, sentiment, and sometimes irrationality. So as we conclude this segment, remember that while market fluctuations can be unnerving, they're not your enemies. They're your companions on this financial journey, providing you with opportunities to accumulate value. Key takeaway 7: Psychology of Investing. In this chapter, we're delving into the fascinating realm of psychology. Specifically, the psychology of investing. Join me as we uncover more insights from the intelligent investor. Imagine you're faced with a critical financial decision. Your mind races, emotions surge, and suddenly you're unsure of your choices. Sound familiar? Well, it's the psychology of investing at play. Benjamin Graham, the sage of value investing, recognized that our minds can be our own worst enemies when it comes to investing. He teaches us that success in the market isn't just about crunching numbers, it's about understanding our own biases and tendencies. One of the most significant biases Graham addresses is our susceptibility to market fluctuations. When the market soars, we're euphoric and tempted to buy more. When it crashes, fear grips us and we're inclined to sell in a panic. By understanding our biases, whether it's the fear of missing out, FOMO, the fear of loss, or the lure of quick gains, we can make more informed decisions. The intelligent investor is, in essence, a guide to mastering our own psychology. So as we conclude this segment, remember that the intelligent investor is not just about numbers on a balance sheet, it's about understanding the human element of investing. By mastering your psychology, you can navigate the market's unpredictable waters with wisdom. Key takeaway 8: Portfolio diversification. We're about to embark on a journey that's all about minimizing risk while maximizing potential, the world of portfolio diversification. Join me as we uncover more wisdom from the intelligent investor. Imagine you're managing a garden. Instead of planting just one type of flower, you plant a variety. Why? To ensure that if one plant struggles, others thrive. Well, the same principle applies to investing. Benjamin Graham, the visionary behind value investing, understood the importance of not putting all your eggs in one basket. He teaches us that a well-diversified portfolio, one that spans different industries, asset classes, and risk profiles, is a smart strategy. Portfolio diversification isn't just about reducing risk, it's about optimizing your returns. By spreading your investments across various assets, you're less exposed to the failures of a single company or sector. But here's the catch: diversification isn't about blindly investing in everything you see. It's about making strategic choices that align with your risk tolerance, goals, and time horizon. So, as we conclude this segment, remember that the intelligent investor isn't just a guide to investing, it's a roadmap to creating a resilient and balanced financial future. By diversifying your portfolio, you're setting yourself up for success. Key takeaway 9: Active versus passive investing. Let's imagine you're on a journey through the world of investing. On one path, you have the active investor, like a chess player. They analyze moves, make strategic decisions, and actively manage their portfolio. On the other path, you have the passive investor. They follow a steady course, investing in indexes and aiming to match market performance. Benjamin Graham sheds light on both these approaches. He recognized that both active and passive strategies have their merits, but they come with distinct mindsets and outcomes. Active investing involves selecting individual stocks, timing market moves, and actively adjusting your portfolio. It requires time, research, and a keen understanding of the market. On the other hand, passive investing involves holding a diversified mix of assets, usually in the form of index funds or ETFs. Graham's wisdom isn't about favoring one strategy over the other, it's about aligning your approach with your goals and temperament. If you have the time, skills, and inclination, active investing might be your path. If you prefer a more hands-off approach, passive investing could suit you. The key takeaway here is that investing should be a conscious choice. Whether you're actively managing your portfolio or letting it ride with the market, the intelligent investor empowers you to make informed decisions and navigate the complexities of both active and passive investing. Key takeaway 10: The lasting legacy of the intelligent investor. We've embarked on an incredible journey through the wisdom of The Intelligent Investor by Benjamin Graham. In this final segment, we'll reflect on the lasting legacy of this timeless masterpiece. Graham's legacy goes beyond just understanding numbers, it's about embracing a mindset of wisdom, prudence, and discipline. The Intelligent Investor isn't just a book, it's a guide to navigating the complexities of the financial world. Through the decades, this book has inspired countless investors to think critically, to invest intelligently, and to embrace a patient, long-term perspective. It's a beacon of light in a world often dominated by market noise and short-term thinking. As we conclude this journey through The Intelligent Investor, let's remember that its teachings are as relevant today as they were when first penned. Its principles withstand the test of time, guiding us through market fluctuations and economic uncertainties. Dear viewers, as we wrap up this enlightening journey through The Intelligent Investor, I want to extend my deepest gratitude to you for joining me in this exploration of timeless financial wisdom. Remember, my friends, the journey of financial growth and success is ongoing. The Intelligent Investor isn't just a book, it's a companion, a mentor, and a guiding light. Let its lessons continue to shape your investment decisions and lead you toward prosperity. If you found this exploration valuable, I invite you to like this video and subscribe to our channel. By doing so, you'll stay connected with a community of like-minded individuals who are committed to intelligent investing. Until next time, keep learning, keep growing, and keep making informed financial decisions. And as always, stay curious and stay intelligent. Thank you, and see you in the next video.